All right, good morning, ladies and gentlemen. Thank you very much for joining us this morning. Today's webinar is about the basics of the LAS natural gas program. I'm joined today with Michael Nigro, the Director of Gas Services at Edison Energy, and my name is Graham Proudley. I'm the LAS Client Relations Specialist. Today we'll be talking about, like I said, the natural gas webinar, which has been around for 25 plus years in a few different forms, dating back to the 80s, known as GasMO. However, as a result of some turnover in the municipal sector as well as BPS organizations, we've decided to do kind of a brief overview of the webinar of the program, despite the fact there's been many long-serving municipalities in the program. In addition to that, while we're speaking about it, I also would like to mention that we'll have a newsletter that we'll start distributing quarterly, probably in the next week or two, so keep your eyes open for that. And we'll also be doing quarterly consumption reports, and that hopefully will be out in the next few weeks as well. For reference, the webinar is indeed being recorded, and we will post this hopefully within the next week or so on the LAS blog, so keep your eyes open for that. In terms of the topics we'll be speaking about today, we'll do a brief rundown of both LAS and Edison Energy, and then we'll do a little bit of a program overview of the LAS natural gas program itself. Mike will speak a little bit to risk management, including topics on hedging, and then we'll talk a little bit about the various pricing components in the program, which would include both commodity pricing as well as a deregulated transportation cost. We'll take a look at both a union gas bill example as well as an Edison Energy bill to show you how your bills would look a little bit different under the LAS program itself. Hopefully you're, as all members of the LAS natural gas program, you're familiar with who LAS is, but if not, you're probably aware of who AMO is, or the Association of Municipalities of Ontario. I refer to LAS as the business unit, and basically AMO would be responsible for providing policy and advocacy on behalf of Ontario municipalities to the province, whereas LAS would sell business and services and programming to municipalities and the broader public sector. The majority of our programs are based in principle in aggregation or group buying, if you prefer. And we're often out at the municipal conferences and doing our own workshops and such, so keep your eyes open for us in your area. And our mandate overall is to help municipalities save money, make money, and solve capacity. Just a quick look at the full listing of LAS's programs and services currently. If you have any questions, we're obviously covering natural gas today, but if you have any questions about any of the other programs or services that you see up on the screen, my contact information will be shared at the end of this webinar, and you can contact me directly and I'll get you in touch with the correct person for the question that you have. That is it for me, very quickly. Just for reference, we're hoping to keep this for about 20 minutes or so, maybe a little bit longer than that, and then we'll have maybe 10 or 15 minutes for questions, should there be any. With that, I will turn it over to Michael Nigro, who's going to talk a little bit about the history of Edison Energy, as well as their relationship to the LAS natural gas program.
Thank you very much, Graham. As Graham had mentioned, my name is Michael Nigro. I'm the Director of Gas Services at Edison Energy for their Canadian division. I have been dealing with LAS since basically our first involvement back in 2007 with taking over as the consulting agent for the natural gas program. My primary responsibilities include the gas purchasing strategies and market intel as it relates to the natural gas program, as well as the team that I manage is responsible for the operational functions of making sure everything is going according to plan with the program in regards to gas scheduling, load balancing, invoice verification, contract admin, all the day-to-day operations that help the natural gas program run as smoothly as it does. There's been a number of different variations of our name over the years since our involvement in the program back to 2007. Originally Energy Advantage back in 2007 when we originally signed on with to manage the program. However, in 2013, the commodities division of Energy Advantage was sold off to Delta Energy, a US-based energy consultant based out of Dublin, Ohio. And then as of 2 years ago, Delta Energy was sold to Edison Energy, Again, an independent energy consultant providing full suite of energy services, not only just procurement, but energy efficiency, renewables, invoicing and bill payment services. But since 2007, the core group surrounding natural gas services has remained the same. So, I mean, important to note is, again, regarding our independence, that we have no ties with any suppliers, utilities, or pipelines, nor do we take any title to gas, which is, gives us the ability to give unbiased advice to our end-use customers, which we continue to give to LAS over the past 11 years.
Just quickly, I did forget to mention before Mike hops into the bit of the overview on the program, we will be taking questions throughout the webinar. There is a questions module in the webinar. If you run your mouse over the screen, you should see a pop-up menu on the bottom, and one of the menu items should be questions, and you can submit your questions, and we will answer those at the end of the webinar.
And the other item that I forgot to mention from the last slide is our legal operating name in Canada is currently Perimeter Energy Inc. So for any of you that are looking at your end-use utility bills and see that name popping up on the bill, that is essentially our legal name in Canada, as currently the Edison name is not registered in Canada. So just a bit of clarification there on the multiple names over the years. In regards to the actual program itself, the program is a natural gas hedging program, which is primary focus is stable natural gas prices over the course of the year. We're looking at price predictability and stability, and we're trying to accomplish that through a 4-year purchasing strategy. So looking at adding in various layers of hedges over the year, with the ultimate goal, again, of price stability, as well as trying to achieve year-over-year cost reductions, which in a few slides we'll be able to show how we've been achieving that over the past several years, as well as giving an outlook into the future as to how prices are trending for the program based on the various hedges that we have in place now. Just some quick statistics regarding the natural gas program. Currently, we have 175 enrolled members in the program, which equates to roughly about 3,500 utility accounts across the 4 major utilities in Ontario. Our total volume that we're purchasing on a daily basis is approximately 11,650 GJs a day. So a sizable portfolio that we are managing. The third-party suppliers that we're dealing with, the current list of approved suppliers includes Shell, AltaGas, BP, and DTE Energy. Important note is that this is a moving list. So, I mean, we're constantly reviewing the list of approved suppliers, looking for price competitiveness in the market as well, too, to ensure that LAS is getting the best bang for their buck at the end of the day. So we're trying to keep competition for the pricing to ensure that we're getting the lowest possible prices that we can in the market at the time that we go to tender for various transactions. So diving right in to the risk management element, this graph right here kind of illustrates the history of natural gas prices, at least going back until 2005. Showing the various segments of volatility or lack thereof over the past several years. Important items to note. I mean, the first half of the graph, you'll notice a lot of price volatility, mainly related to the natural gas industry itself being based primarily on offshore drilling. So you'll see there segments of when Hurricane Katrina and Rita hit the Gulf, there wiping out a lot of production and the associated impact on pricing. Same can be said for having colder winters during that time period when production was very limited. A cold winter would definitely add some disruption to pricing in the daily market. But since then, as some of you may be aware, there have been improvements in natural gas drilling, specifically hydraulic fracking and the exploration of shale gas. And that's most notable in, say, from 2009 up until current, where we've seen a lot more a shift from that offshore drilling to more inland, and an abundance of shale gas that is available to the market. Some of the complications that we've run into over the past several years, what the industry has been looking to correct, is getting the proper infrastructure to get gas to market, which we're basically at a good spot right now, which is indicated by the relative stability that we've seen in pricing. But this has also been presenting good purchasing opportunities in the forward market. Obviously, a lot of unknowns going into the next 3 to 5 years on the demand side, especially with LNG and exports to Mexico increasing. And on the flip side of that, producers essentially losing money at these price levels. So there's a lot of different factors that are contributing to prices ultimately recovering gradually over the next several years. But again, given where the current market is at, good opportunities for the program to layer in additional hedges and work down the average price over the next few years. Another key point that I like to look at in this graph is, and gives way to the title of this slide, Expect the Unexpected. Looking at the winter of 2013, 2014, the polar vortex basically caught the market off guard where nobody was anticipating that. And essentially we saw a spike in prices that we hadn't seen in several years. For those customers, such as the LAS program, that had hedges in place, were well protected and didn't have to worry about budgets or additional funds to cover the spikes in prices that we saw during that period. So while the polar vortex was a bit of an anomaly, it does show that given the amount of production that we've seen in natural gas, there is still a bit of volatility that exists in this market. So at a high level, from the perspective of hedging, what is a hedge? Well, essentially hedging is we're taking a market position that reduces the risk of price movement. So essentially we're purchasing a portion of natural gas, a certain volume at a certain price for a certain period of time from a third-party supplier. So from your Shells, from your BPs of the world, you're agreeing to purchase a certain amount of gas at an agreed upon price, which is dictated by the market conditions at the time at which we go to execute. Why are we looking to hedge? Well, again, what we stressed on at one of the beginning slides there is we are looking at budget certainty. We're looking to reduce exposure to movements in the commodity price, something that you don't get through utility rates, which essentially are a flow through of market prices more or less, but can change up to 4 times a year depending on what market conditions are doing, and depending what utilities are going out and buying their gas for, and flowing that through to the customer. But ultimately our goal for any of our customers that we manage, including LAS, is about looking at stability, looking at achieving budgetary goals, and from a savings perspective, trying to look at year-over-year cost reductions. Now, obviously, when is the perfect time to hedge? When is the crystal ball working at its best? From looking at a perspective of when to hedge, we break it down into market timing versus risk management, or fixed price purchases versus speculating. For customers that are trying to hit the absolute bottom with the goal of profiting from that purchase, that's more the view of speculating. Whereas, fixed price purchasing and, the way that we're managing the LAS program itself, the ultimate goal is to give price certainty, budget certainty, and remove some of that risk from a potential volatile market. Another key item that to highlight to the members here is the difference between what we refer to as direct purchase or third-party supply versus system gas or utility supply. So direct purchase is a common term that we use in the industry, which is essentially sums up the LAS natural gas program. With direct purchase, we are purchasing your actual gas, the molecule itself, from a third-party supplier. So, for example, Shell. And we're delivering that gas to the local utility, your Enbridge, your Union Gas, for distribution to the end user. The customer is paying the supplier for the commodity and deregulated transportation, and then pays the utility for the regulated distribution to move the gas to the end use site. With direct purchase, the key distinguishing factor between direct purchase and system gas is that you have the ability to hedge in the forward market with direct purchase. With system gas, you do not have that option. You cannot call up Enbridge or Union Gas and say, I want to fix my price for the next 5 years. They would then refer you to somebody like myself or a retailer that would look to set you up with a fixed price. For system gas customers that are buying their gas directly from the utility, there's no ability to hedge. The prices are set on a quarterly basis and are more or less a reflection of what the spot market is doing at that time, or what the utility is essentially going out and buying their gas at. The utility cannot, in the province of Ontario, the utility themselves cannot take a forward position in the market. They cannot make money on the sale of natural gas. It is more or less a flow through of the price that they're paying. Another good example of this is during the time of the polar vortex, and you might hear me mention this a couple times over the next 10 minutes, but during the time of the polar vortex, utilities were going out, and because the system was so drained and there were so many constraints on the system, they were going out and buying gas in the day market at double-digit prices, and essentially had to flow those prices back through to the end users. So for system gas customers at that time, noticed a significant increase in their gas prices during that period, mainly due to the utility having to cover their costs of buying additional supply during that time. Some of the benefits here for purchasing your gas via a third-party supplier versus system gas. Procurement strategies that are congruent with customers' purchasing objectives and risk tolerance. So we're designing strategies that best meet our customers' needs. So knowing that not every customer is the same, not every customer is the same when it comes to their risk tolerance. So we come in, we have the discussions with the folks here at LAS to discuss risk and get a flavor as to how best to design the strategy and how best to design the portfolio to achieve the various goals, the purchasing goals for LAS and the members. We've mentioned this a bunch of times. The next 3 bullet points: price certainty, reducing volatility, cost control. Those are the main components for the main takeaways for our customers for entering into third-party supply. I'd say the good 95% of our customers understand that when you're getting into this, you're not getting into this to necessarily beat the market or beat utility. You're looking to take risk off the table. You're looking to stabilize your gas prices at the end of the day. But doing it this way, using a third-party consultant, we're trying to do it intelligently, understanding that anything can happen in the market, but we want to ensure that if anything happens to the upside, that you're properly protected and don't have that much exposure to movements on the upside of the market. We're providing customers with the ability to take advantage of potential buying opportunities in a timely fashion. Again, from being on the program, from being on direct purchase, customers can act as soon as the price that tickles their fancy shows up in the market. For customers that say follow the market but are in utility supply and want to act on a current forward price, well, you have to go through the necessary paperwork of doing the necessary contracts with your utility and arranging with a third-party supplier, which sometimes can take months to do. And obviously with a market that changes minute by minute, that desirable price that was there the day that you wanted to act may not be there a couple months from then when you're able to actually transact. The last one is key, especially dealing with multi-site customers such as the LAS program. Corporate planning. We're trying to centralize and create a harmonized portfolio for natural gas purchasing, and trying to avoid for customers entering into separate, potentially crippling gas contracts themselves. We all know the door knockers, the people that come to our businesses asking us to see our gas bills and asking us to basically set it and forget it, sign a natural gas agreement that goes 3 to 5 years at a fixed price, only to find out that it wasn't that great of a price when you originally signed up. So we're trying to, again, create harmonization, create a portfolio purchasing solution for our customers. This next slide just gives you an overview of how the program has done over the past several years, using the comparison of spot market as well as an Enbridge utility rate. I like to use this example for a lot of customers that we deal with, that this is kind of the perfect scenario that we've seen with the LAS program, that downward moving staircase as far as prices go. You can see that it's been consistently moving down. While there has been a bit of disconnect in certain years, we have been tightening that gap. But this is what we want to see from a hedging portfolio. You don't want to see prices going all over the map in periods of ups and downs and all over the place. You want to see that steady downward movement, and that is the way that we've successfully achieved that in the program. And the way that we're structured with the hedges currently in place on the go forward for the next 3 to 4 years, we're going to continue that downward movement in the program. So we're on the right track and have basically tightened up that gap between the LAS program and what's been going on in the market as of late. What's key to note here as well too is with market prices been doing what they've been doing as of late, we like to see that, or like to think that we're scraping the bottom right now. That a lot of producers are taking a financial hit with gas prices at these levels. Not a lot of turnaround or funds coming in to producers at these points. So there's more risk, I think, at this point to the upside, to the down. Are we going to see extreme movement to the upside? Probably not, but I think we will see that gradual recovery in prices. So while the spot market starts to tick up, we're going to see, again, the way that the LAS program is positioned right now, we're going to still see that stability and still see that gradual downward movement. Getting into the actual price components for natural gas that the members will see on their bills, there's 3 main components when it comes to natural gas. There's the actual commodity itself, the physical molecule, there's the transportation, and the distribution. So the first 2 items there, the commodity and transportation, are managed through the LAS program. The commodity is the price of the actual gas itself. It's deregulated in all provinces, and it's based on a continental market based off of NYMEX. AECO in Alberta is the main trading point, which trades at a basis to NYMEX. But the commodity price is the actual physical molecule itself. For transportation, this is the actual price to move the gas from the supplier to the utility. So with this, there can be it can be partially deregulated. So we're managing on behalf of the LAS program, we're managing the deregulated piece. So the movement of gas from the supplier to basically the city gate, basically to the utility's doorstep, more or less. In some cases, depending on delivery obligation, actual geography on where locations are based in Ontario, there might also be a regulated component in which the utility charges the end users a price to move the gas further into the system. And finally, there's the distribution piece, which is the actual price to move the gas from the utility to the actual meter. This is regulated in all provinces. This you are paying regardless of whether you're purchasing your gas from the utility or from a third-party supplier. The distribution cost, important to note that as of January 1st, 17, also includes the carbon tax, the dreaded carbon tax, which has been a headache for a lot of customers. But I guess as of June 7th, we will certainly see how much longer that lasts. Doug Ford has some work ahead of him, but we'll see in the coming weeks, and then I can foresee some bulletins coming the members' way regarding how cap and trade and the carbon tax unfolds over the next few months as Mr. Ford tries to unwind what was done by the Liberals previously. So not going to play the politics game today. So The actual price calculations themselves, so this is something that we go through with LAS on an annual basis for setting the upcoming program price for the year for both the commodity and deregulated transportation. It's pretty straightforward, where we look at the various hedges that are in place that we have in place for the given year, as well as incorporating the portion that is floating on spot market. So something that I maybe didn't touch on in one of the earlier slides is for the given contract year that we're dealing with, we look at a max threshold of about 80 to 85% that the program is in at a fixed price in various layers, leaving about 15 to 20% exposed to spot market. Again, we like to approach these strategies intelligently, not doing just all-in fixed price, as we understand that anything can happen in the market. We want you to have that protection in case the market does start to run up. But at the same time, if market softens, we want to ensure that you do still have that exposure, and it does help bring down that weighted average price at the end of the day. But from the commodities perspective, we're looking at all the various fixed components that we've layered in over the years. We're providing an estimate for the portion that is riding on spot market. We also have the LAS program fees that are incorporated into the price itself, as well as contingency of about 8 cents per GJ, which is to cover any unforeseen fluctuations in the market, load balancing transactions that we're managing that might impact the prices negatively. So we do have that added contingency in there as well too. And then ultimately we come up with our total commodity price. So you can see there we have the calculations for the current year, where members are paying 11.9 cents per cubic meter for the actual commodity itself. And this kind of gives you an outlook right now how things stand for the natural gas commodity, just for the commodity prices, but also includes our spot projections, contingency, and fees. Obviously, these are subject to change as we continue to add in more hedges over the next several years, and as spot market conditions change as well too. But again, as mentioned to previously, you can see that gradual downward movement continued for the natural gas program over the next several years. We're forecasting out to November 21, October 22, being around the 9 cent range right now, which is outstanding. Looking at about 4 years out to be below 10 cents per cubic meter, I think it's a win for the program. So this is exactly what we want to see. We don't want to see prices all over the place. We want to see that continued downward trend, and that's what we'll be aiming at over the next several years as we continue to provide strategies to LAS to execute on. Another key item that I should also note is that at the end of the day, all transactions are executed at the approval of LAS. So we're not going out and executing any transactions without getting written approval from the members that we deal with here. Again, it could be the best deal in the world, but we need to ensure that we have the proper checks and balances of dealing with the customer themselves. So important to note that we're not acting on our own when we're going out and arranging these hedges. We are fully involving LAS through giving them the proper backup, the market updates, the market intel, and giving them the justification as to why we're adding in layers when we're adding layers and at what price levels. On the deregulated transportation side, same kind of concept as the actual commodity, where we're looking at the various layers in transportation that we've arranged. Again, providing strategies to LAS for the various deregulated transportation components. Without getting too deep into the weeds here, I previously mentioned, deregulated transportation at the end of the day is based on geography. So you'll see us there throwing around various delivery points such as Dawn, such as Empress. Again, it's going to be specified based on the actual utility that the program member is served by, and their actual physical geography will determine how we deliver gas into the utility system. So along the same lines as the commodity, We are looking at the various layers of transportation, of deregulated transportation that we've arranged for the program, and calculating the weighted average price, and that's what's showing up on your gas bill, depending on where you're located and what utility you're serving. And a couple examples here of what it would look like to the member at the end of the day. Looking here at a Union gas bill. So a lot of you will see the name. Again, we mentioned Perimeter Energy Inc. is our legal name. So we are the natural gas consultant. And again, can't help but stress, we are not the actual retailer or reseller of natural gas. We are not taking the title to the gas and reselling it to the LAS program. LAS is directly contracting with the Shells, with the BPs of the world for the actual supply of gas itself. We are mainly the third-party consultant that are helping arrange these deals and provide strategies and advice in regards to purchasing for the program. So you'll see the name Perimeter Energy across these bills. Again, because we're the ones that are ultimately submitting the prices up to the utility and are responsible for managing the program, that's why you'll see our name plastered across the bill there. The first line there, this is a Union gas bill, and this is actually for a customer in Union Gas's Northern Territory. So the gas used line item there, you would see a combination, that would be a blended price of both the commodity and deregulated transportation. So the 11.9 cents plus the 4 point whatever cents to bring you up to the 16.4 cents per cubic meter. You then, as part of this, again, based on the setup with this utility, there's also a regulated utility transportation charge and regulated utility delivery charges, again, to move the gas from the utility to the end-use meter.
Before you move on to the Enbridge bill, just quickly, it's important for Union Gas customers to note that combination of the commodity and deregulated transport. That's one of the more common questions that we get is, how come your price is 11.9 cents, but it's showing up as 16.4 on my bill? So that's the addition of that deregulated transport to the commodity charge. So if you're in a Union Gas territory, you might want to write that down quickly, or just take note of that as next time you look at your bill, you're not going to see just the LAS commodity price. It is a combination of the two.
Exactly, yeah, and it just comes down to the utility. They blend it all into one line item, whereas as we get to our next example here with Enbridge, you'll actually have the breakdown. You can see in that middle section there, you have the breakdown of the actual price for the commodity as well as the price for the deregulated transport. And then above that, you'll have the regulated utility, regulated transportation charges and the regulated distribution charges as well too. But it gives you the breakdown there of the various price components related to your natural gas costs.
So that's basically it for us. For those folks that are new to their municipalities or their organizations that were not familiar with the LAS natural gas program that the organization was participating in, we hope this has been enlightening for you. I don't think we've seen any questions come in, so we'll hang around for another minute or two. Again, you can use the menu that shows up on your screen when you move your mouse over the webinar screen, and there's a Q&A module. We haven't seen any come in, so we'll kick around for a minute or two, and if we don't see any, I guess that will be it for us. But in the meantime, my contact info is on the screen, so if you do think of anything following the webinar that you'd like to have answered, you can get in touch with me directly by phone or by email, and if need be, I will get in touch with Michael here for some help with some of the more complicated things on deregulated transportation and carbon taxes and all of that sort of stuff. I guess at that point, I still don't see any questions, so I'll thank you all for joining us, and we'll leave you be for the rest of the day. And thank you very much, and hopefully this has been insightful.